and 80,000 branches. We went from 15% of the balance sheet in treasuries to 25% of the balance sheet in treasuries. So why are banks in the business of buying treasuries? That's not why they were created. And if you look at SVB, you'll see that another problem they had was that their expense ratio and operating efficiency was going the wrong way. So why does a bank that has 56% of their assets in treasuries have an efficiency ratio of 65%? I can find four guys that it takes to manage a securities portfolio. It doesn't take much. So, reiterate again, I think the excess, as long as we have excess capacity in the banking sector, we're going to have these kinds of problems. And this was regulatory failure straight out. Interest rate risk can be summarized in the entire banking sector on a two-page report. It's not like we're trying to deal with credit risk. We're dealing with simple numbers. Bond price yields go up, prices go down. We should know the risk. So that's just a few thoughts I have on the situation.
I'll just add to that too. The Federal Reserve has been very clear communicating to the markets that they were going to have ongoing, rate increases. This has been going on for a year. So these banks have had time to manage their portfolios, sell off some of these low yielding bonds that they have, and you have a bank like Silicon Valley Bank who, they had, I think 120 billion of, investable securities, and just look at how they manage that. 75% were mortgage-backed securities, but which is fine, but they had an average yield of 1.6% with a 6-year duration on that. They had time to, in my opinion, to rebalance that or somewhat. So the Fed has been raising rates for a year, so
But
any
but
responsible
don't you?
banker should have seen this, because the Fed telegraphed this and they could have manage
Well,
that risk. And
but
if they don't, they deserve to go out.
but also bear in mind that the Fed was late in telegraphing this. They gave everybody all clear on the horizon in 2021, saying we are not going to thinking about raising rates till 2023, 2024. So they kind of gave the okay signal to go out on the risk curve a bit. And in terms of the Fed telegraphing their rate hikes, the bond market sells off before the Fed even gets off their ass. Let's be real about this. I mean, just like we're seeing, people want to wait for the Fed pivot. If you wait for the Fed pivot, you'll be broke on the way up and on the way down. So,
Well,
2 years and 5 year notes were trading up way before the Fed decided to, way before Team Transitory was disbanded.
Yeah, but the 2-year yield was below 2.5% through May of last year. So I think they started raising rates in like February or March. So they had a little bit of time. Once the Fed policy does a full shift into tightening mode, they knew this wasn't going to end with just a few
you
rate
know,
hikes,
yeah, Name.
given
I would just
inflation.
say I would add to what Bobby was saying, and that is, and what Bobby just said is absolutely correct, which is, the language that the Fed has been using for a very long time, including up until just recently, right before the Fed hikes, we're not even thinking about raising rates, was sending the wrong message to the market. So they've been telegraphing something that I think confused a lot of people. Now, you're right. I hear this all the time. Why aren't these banks hedging their interest rate risk? I think a lot of people just think hedging risk just comes without any other risk, right? Risk doesn't disappear. It doesn't leave the system when you hedge it. It just gets placed with someone else. And so, in order for everybody simultaneously to hedge their interest rate exposure on their books, someone has to take that from them, right? And so, again, I go back to, if we had a situation where prevailing rates were, say, 4%, let's say we're in an environment where they were 4, and plus or minus 2 from 4, either go up to 6 or down to 2. In an environment like that, market participants have different, different balance sheets, different business models, different modus operandi. But when everybody has effectively the same balance sheet because of 12 years of money printing, QE, 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 and ZERP, everybody had the same thing. And so when everybody has the same thing, how in the world, who's going to take the risk off your balance sheet? I go, this is going back to Deutsche Bank and going back to Credit Suisse and First Republic and Silicon Valley and God knows how many other. I mean, literally everybody. I mean, look at the banks today. I mean, the reality is you can't offload risk, without somebody taking that risk on. And so
Okay,
it's a hot
so
potato.
I'm going to
It's
take
it's,
the
it's
okay,
other
so
literally
I
side
a
of
have
it.
a
hot
comment
potato.
on that.
I'll take the
So
other
what?
side of that.
Well, let me say one thing first. So forget about even putting a hedge on or whatnot. What about going to the markets, capital markets, and raising more capital? Like their stock price of these banks were at all-time highs. Like Silicon Valley Bank was trading at $700. Why not just go do a secondary or something? There was other options they can do. Is my point.
Well, hold on. When you're raising capital, if you're selling stock, you're diluting existing shareholders. So
Yeah,
that's not
well,
going to
at
fly.
seven
No
hundred
one's
bucks,
going
who
to,
cares?
hold on a second. No one's going to want that. And if you look at what happened in the GFC, and you go back to even companies like Credit Suisse, Citibank, for instance, Citibank is nowhere near where it was prior to the GFC, right? And so, these banks, yeah, they can sell equity. The problem is who's going to buy it and at what price, right? What's the clearing price for that equity? What is it worth in
Yeah,
that
well,
environment?
it's too late now.
It's like
I'm
buying
just saying.
insurance when the house is burning. Exactly,
Yeah,
right?
they had a chance. Is my point is that they had a chance, and to me, it's like unfathomable they can call themselves bankers while failing to understand the concept of interest rate risk. Like they've had time
Well,
for
I
this,
don't think it's that they
you
didn't
know.
understand. I don't think that's exactly fair because I don't think that the bankers didn't understand that there was no risk. I just think the bankers were hamstrung by the Fed and the ECB and others because of the situation with what prevailing rates were, right? When you have zero
Right.
rates and you have a policy by the Fed to keep rates indefinitely, at effectively zero, 12 basis points or what have you. What can you do? What can a banker do, right?
I
And
just
It's
think
so
the
moral.
responsible bankers managed the risk because they saw, where the Fed was going. They had
I'm not
time.
sure. I'm not sure this is over. By the way, so when you say the responsible, that statement presumes that this is contained and everything's fine. I'm not sure that's the case.
Yeah,
I
I'm
have a
not saying
feeling
that
this
either.
is
I
yeah,
agree
yeah.
with you.
I have a feeling this is going to be a rolling problem, and I hate to say it, but we're maybe in the first inning of this.
Yeah, I agree. I
Can
agree with you.
First of all, I mean, there's moral hazard. So, bankers have lived in an environment of zero rates. So, you don't have a problem. And if there is a problem, then that will just continue. So, I think probably that's one explanation. What I would say in regards to the Fed announcement about sort of, well, first of all, them raising rates, but then giving guidance that they're going to hold rates at what I think by the end of 2024, rates won't be below 4.5%. I think that's the mistake because anybody looking at that and having problems with interest rate exposure is just going to say, risk off. I'm out of this market because these high rates are here now for the next 12 to 18 months.
By the way, here's another thing, guys, that I think is lost on a lot of. I haven't really heard this, but I'll bring it up because I think it's very important to keep this in mind. We have debt ceiling that's going to need to be raised going into June here. That's going to be another shitstorm here. All of this is this is one storm after another. Just in January of this year, the cost of living adjustment hit the Social Security Administration. They raised it by 8.7%, the cost of living, the COLA, right? So on one hand, the federal government's spending all this money sending money out to tens of millions of Americans, right? The Social Security Administration, among other social safety nets. At the same time, the Fed is raising interest rates, which at the same time is slowing the economy and at the same time creating banking crises. So all of this is kind of happening all at once. And of course, the last thing that the Fed wants to do is keep inflation high for indefinitely because the system doesn't work. You can't have cost of living adjustments every single year going up 7, 8, 9%. That just can't happen. The system's already broken. They're trying to fix it. This is not the way to fix it, right? We need growth. We need the economy to grow. We don't need a shrinking economy, right? We don't need stagflation. And I think that's kind of where they're taking us, because this inflation is sticky. There's no doubt about that. It's the velocity of this inflation that's really the key. And I think it's slowing, and it's slowing quickly. And I think I think they need to address that.
Yeah,
O'Hare,
just I'm sorry.
can I,
Go ahead.
O'Hare,
Go
can
ahead.
I ask you a question? So then, what do you think the Fed should be doing? They should let the inflation continue to burn hot.
Yes, that's exactly what I think they should do. And remember, they could, the Fed, I actually tweeted this out. I put it in the nest that somebody took it out, but I tweeted this out last September. I said, the Fed, really what the Fed should do is increase I think the real problem here is this idea of this 2% state of inflation, right? The world doesn't work on a 2% inflation indefinitely forever. I mean, it's crazy to think that. You're going to have bouts of inflation. You're going to have bouts of deflation. You have to be nimble, right? The Fed is not nimble. The Fed wants to keep this 2% mandate, and I think that's crazy. If they raise the mandate even temporarily for, let's say, the next 24 to 36 months, say to 3%, 3.5%, maybe even 4%, I don't think that's a cataclysmic decision. I think we could live with that, right? The problem is, by having a 2% mandate and raising interest rates the way they did so quickly, you are trying to fix one problem but creating a dozen other problems. And by the way, those other problems are going to be fixed by what? The same thing that we fixed the last set of problems with, which is more money printing, more QE, more asset, purchases, and so forth. And so it's idiotic for me to think for these guys to continue doing the same thing over and over and over, raising the limit for inflation, the targeting, just simply to 3.5%, I think would alleviate a lot of the stresses, would allow the system to kind of absorb what's already happened, and let's revisit it a year, 2, 3 down the road and see where we're at. I don't think that's too much to ask. I think that makes sense in my mind anyway.
Yeah,
So, oh, go
go
ahead,
ahead.
Bobby.
Go ahead. No, I hate to agree with O'Hare so much, but yeah, I think the Fed has had a closet 3% target for quite some time. I know some people that would agree with that premise, but I don't think they want 2% inflation. They don't want 1% inflation, but they would prefer 3% inflation, and that's probably been their target for 4 or 5 years. The second thing I want to point out is that the duration risk has been rising in the bond market, and I've been talking about duration risk for some time. I just completed a paper. It's going to be part of it is on LinkedIn. I'm going to be doing um, more a series on this. But the duration, a modified duration of the global bond market has doubled since 1990. So, in essence, when we had rates at zero bound, uh, two, three things were happening. One, uh, bonds were being issued with almost zero coupon or even negative rates. Two, people were terming out debt and extending maturities. And three, because debt had exploded during that time period, a shitload of debt was issued with low coupons and longer maturities. So that was basically creating a duration time bomb out there where the next crisis was going to be a duration crisis, not a credit crisis, because we have sovereign uh, countries. We have countries using their sovereign debt rating to kind of absorb credit problems and to intercept in pandemics and other situations, intercept credit risk and put it on their balance sheet. So I think, and look what has happened in the UK. We now have UK uh, sovereign rating at AA3 on its way to single A. So the question arises, is safe asset status being threatened? And what does that mean longer term?
Well,
But I
and
agree
Bobby,
with O'Hare.
Bobby, I would also say, I would add to that. I would say that just because we don't have a credit crisis or this perceived credit crisis at the moment, doesn't mean we're not going to have one tomorrow or next week or next month. And I think all of this kind of precedes what could happen down the road, which is you create a situation where everybody's everybody's afraid to do anything. The economy contracts. You go into a recession. Prices fall, asset prices start to fall, which is happening now right before our very eyes. And that's when you have that credit contagion. That's when you do have those things happen. And we may not be far from it. I mean, we may be actually at the beginning stages of it. And this is why it's so critical for the Fed to pull their head out of their ass and say, look, we're okay with a higher rate of inflation for maybe a longer period of time, and we're going to kind of alleviate some of these stresses that we put on the system. That makes, to me, more sense.
100%.
Yeah, we're just
Yeah,
waiting
no.
for
I was
a shock of some kind. I mean, I think all what's happening at the moment, I think, is manageable. I think central banks can manage this, but we're waiting for something, on the macro level, geopolitically, to happen. I mean, we've seen.
Jonathan, I think you dropped out. Yeah, you dropped out. I'll ask this question. Maybe go with Tom first. Tom, what would you, Tom and O'Hare, I'll ask you guys that question. Kind of to wrap up the space, final thoughts. What would, and I'll ask that question for the audience too. What would be concerning to you? What is one thing if you see that happening, you'd be like, okay, shit. An indicator that says things could get a lot worse, if we could see a contagion worse than expected. The Fed needs to act, and we're getting into uncharted territories. Who would like to take that one first? David, Tom, or O'Hare?
I'll jump in.
Go ahead, Nate.
What worries me is, again, what we don't know. And during the last, let's just call it since the pandemic and the amount of monetary policy easing they did, and how much stimulus was injected just in the last few years. Okay, who took on irresponsible bets? Who's going to be exposed? That's what worries me the most. It's not necessarily going to be Deutsche Bank or what we're talking about here today. It's like an AIG type situation, and that's like very hard to predict. But I know they're out there. You just don't know. And I just think that's part of, to wrap things up here, is like part of what we're seeing in the markets, of why you're seeing investors, de-risk. It's not happening in the broader market, but it's mainly financials where, that exposure could be. It's just very hard. It's impossible to really predict where there's going to be a big fire, and we'll just have to wait and see.
I would have been more
would
worried
say,
myself if we
go ahead.
if we had not seen the Fed raise rates. I would have been much more